So buying a home in today's market can be very complicated, and making a mistake can cause you thousands of dollars. So what I want to do today is share with you 5 mistakes plus a little bonus that customers can make when buying a home that we really want to avoid. So let's get into it. The first thing is relying solely on either the pre-approval or the pre-qualifier. What you get from a lender in terms of a pre-qualification is not a good thing to base what you want to spend on a home. Remember, the lender is there to help you spend money. That's their whole point. They want to help you get a loan. They're going to do everything that they can to help you get that loan, even if it means putting you way over your head in terms of being able to pay that loan back. Now, remember, there are two things going on here. There's a pre-qualifier and a pre-approval. The differences used to be very stark, but back around 2013 or so, they kind of jumbled the differences. So I'm going to give you a better idea as to the difference between a pre-qualifier and a pre-approval. The pre-qualifier is basically your idea of what you make and what you spend. That means that you're just kind of going off of, well, what you have in your memory. I make X amount per month and I spend X amount per month. That's not going to get you where you want to go when it comes to buying a home. When you get into the pre-approval process, that's where you have actually picked a lender, you feel comfortable with them, and now you want to give them all of your tax documents, your work documents, your 1099s, all of that stuff. And so once they have all of that documentation, now they can actually give you what a lot of times I like to call a gift card. So if you can afford $300,000, then now you have that pre-approval, which is kind of a gift card that says, okay, if you want to buy a house, you're good up to 300. Anything over that, you've got to pay out of your pocket. Now, if that's what the lender tells you, and we're just going to use $300 as an arbitrary figure, if that's what the lender tells you you can afford, that doesn't necessarily mean that's how much you should borrow. If that $300,000 is going to make it to where you're strangling yourself at the end of the month to be able to pay your bills, then don't do it. Make sure that you know what your comfort zone is and use that, giving yourself a little bit of breathing room at the end of the month to be able to pay other bills and do other things that you need to do. So that's the first thing. The next thing is not having enough in savings. So one of the things that we want to think about when it comes to buying a home is there's more to buying a home than just the down payment. So let's say, for example, you've got $15,000, $20,000 in the bank. There's still other things that go into buying a home. Now, I know here in the state of Florida, especially in Central Florida where I'm at, one of the things we recommend is to have 2 different inspections done. One of them is a standard 4-point, which means that the inspector is going to be looking at the roof, the electrical, the plumbing, and the AC, and as well as anything else that might be messed up that you need to be aware of. That's usually going to run around $400, maybe $450, depending on the home. And then we also have people look at a WDO inspection, which is a wood destroying organisms inspection. Now that could be different in your state, but here in the state of Florida, we have everything from termites and boll weevils to fungus, rot, mold, mildew. I mean, all kinds of things that eat wood. And so what we want to do is have them check that out to make sure that there's no underlying issues. And that's usually around $100, $125, no more than $150. So right there, you have additional expenses. Now, back in the day, the lenders used to go ahead and just kind of like take the appraisal and lump that into the loan. They don't do that now. Now they charge you for the appraisal, and you have to pay that up front. That's another $400 or $500. Could be even more than that, depending on the house. And so those are other expenses. Then you still have your escrow deposit. Your escrow deposit is kind of your good faith deposit that you put on the house when you get a contract signed and it's been accepted. That's going to be what's going to go with the contract. That's going to go to the title company or to the lawyer's office, and they're going to be the ones that will be handling escrow or handling title for you. Now, that can be anywhere from $1,000, which is fairly customary, to I've actually had customers go $5,000, $20,000. I had one that was over $75,000. Of course, that was on a $2 million home. But the point is, those are all expenses that you want to keep in mind. And the more competitive the market, the more you may have to put in that escrow in order to really get past the seller and all of the other buyers that are competing for that home. And then you still have the next thing that we're going to talk about, and that's closing costs. So aside from the down payment, which depending on your loan could be 3.5%, could be 5%, could be 15 or 20%, you still have closing costs. Now, typically in the state of Florida, closing costs range between 3 and 4%. Now, in some states, they can go as high as 6%. Basically, closing costs, to help you get a better understanding, closing costs are the charges, the costs that are incurred through things like taxing, handling different pieces of paperwork and documentation. The way that I like to explain it to my customers is anytime somebody touches your paperwork, whether it's virtually or in the real world, you're going to get charged for it. So closing costs can be an additional 3 to 6% depending on where you're located. That's also something you need to kind of have a strategy for, because having $10,000 in the bank sounds fantastic until you start to add all of these costs up. So bear in mind that closing costs can be a big part of the puzzle in terms of being able to get a mortgage and being able to buy a home. The next thing that we want to talk about is the lack of a clear timeline when it comes to purchasing a home. So I've had situations where people have come to me and said, okay, I've got to be in Jacksonville, I've got to be in Tallahassee, I've got to be in Georgia for a job, and I need to be there in the next 30 to 60 days. Well, that can pose a big problem. First of all, in a very competitive environment, we don't know how long it's going to take to get you into a home. Second, if you don't know exactly what's going on, in other words, if you haven't already been in front of a lender, you haven't already had your credit checked, you haven't already talked to a lender and got pre-approved, that's going to take time. And the more time we waste dealing with that, because let's say, for example, you don't have a good credit score, and it could take a little bit to get you there. If you knew ahead of time that you were going to be making this move and you waited until the last minute to actually start getting prepared, that could be death. And so the more prepared you are going into this, the better off you're going to be. What we want is we want you to be completely prepared. We want you to be ready to make that happen, because pretty much all around the country, it's still a very competitive market. We're still seeing homes, even though we've seen homes stay on the market longer now, we're still seeing homes come off the market in fairly quick time. And so depending on where you're at, depending on where you're looking at buying a home, you may have competition. And if you have competition, you're not prepared, that home that you really, really want could end up going to somebody else because you weren't ready to make that deal. So my advice to you is get prepared ahead of time. If you're thinking you're going to want to get in a house in the next 6 months, don't wait until 2 months before you're ready to go. Let's say, for example, you've got your lease that's going to be up in 6 months. Don't wait until 2 months before your lease is up. Start preparing 4 or 5 months before your lease is up. Start getting a clear understanding what the market's like. Start getting a clear understanding of what kind of home you want, where you want to be, what kind of money you want to spend. Talk to the lender, figure out what you can be pre-approved for. Even a pre-qualification at that point is going to be a good thing. And don't worry about there being a nick on your credit, because you're going to a lender to ask them about what you could get either pre-qualified for or pre-approved for. Just ask them to do a soft pull on your credit, a soft pull on your credit. That soft pull will keep you from getting nicked, and that way when you're ready to make that purchase, you're not going to have an issue. So the next thing that we want to talk about is trying to find the perfect home. Now, I don't want to say this like just find whatever kind of crap you can find and then that's going to be it. What I want to say is don't get stuck on the home having to be absolutely perfect and having to check off every single box that you've been looking for, because that's probably not going to happen unless you build a custom home, which is going to be a lot more expensive. So if you're looking at pre-built homes, then you really want to start thinking about, okay, what are my 5 or 6 most desired features? What are the things that I really can't live without? And then what are the things that I really like to have, but I could live without them if the house has everything else that I'm looking for? One of the worst things you can do is try to find the home that fits every single desire that you have, because it's not out there. Everything is going to change with every home you look at. So the home that has 4 out of 5, the next home may have 6 out of 6, but it still may have things that you'd like, but you could live without. Try to keep a very open mind and try to be realistic when you're looking for homes. Try to find the best of the bunch, and don't look at homes like when you're looking at homes online and you're scrolling through the pictures and whatnot. Try to be a good detective. Try to think in terms of not what I like about the house, but when you're looking through those homes, try to nitpick. When you see a blotch on the carpet, okay, I don't like that. Now, that doesn't mean that it's not something that can be dealt with, but as you're looking through the pictures, be a good detective. Look at the pictures with an eye towards what's wrong with the home, not what I like about the home. So this way, when you see nicks in the counter or chips in the countertops or, paint that's peeling or paint that doesn't look quite right or, whatever the case may be, you're aware of that, and you can exclude that if you find better homes that look better. I hope that makes sense. All right, now this last thing is it kind of depends on your way of looking at things as to whether or not this is going to be, something for you to be concerned about. So this is kind of a bonus. But this is something that I have seen occasionally, and it is something you want to address, and that is speculating on future gains. There are people that will go out, and one of the ways that they make a decision is how much will this home be worth in the future? Well, that's speculation. When you're speculating like that and you're buying a home based on what you might get from that home in the future, it's kind of a no-win because we don't know where the market's going to go. Could anybody have guessed that back in I think it was 1981, 1982, that between then and 1986 or so, that the rates would go up to over 18.65%? Who knew? And who would have guessed that the rates in 2020 would go down to 3% or less? Nobody really figured that out. And so for you to say, oh, well, my home, if I buy it now and I live in it for 5 years, it's going to be worth X. Tell that to people in 2008 when the market crashed and their homes were worth less than half of what they paid for them. You just don't know. So, the only thing that I can tell you is get into a home that you think is going to fit the bill for you, your family, or whoever's going to be living with you, and let that kind of stand on its own. The market's going to do what the market's going to do, and we can't force it to do what we want. So as long as you're happy with the home when you buy it, eventually the homes rise in value simply because homes rise in value. There's no more land. That's all you got is what's out there. So it's not like they're making more land. So eventually, if you look at it from, a historical basis, and especially when you overlap the home market with the stock market, you're going to see that even though there's ebbs and flows, there's ups and downs, the trajectory is always on the up. It just takes time. So those are the things that I wanted to cover with you guys. Hope you guys enjoyed this video. If you are planning on making a move to my area, which is Central Florida and the Tampa Bay area, feel free to let me know. I'm going to leave a link pinned to the comments below. And you can set up a call with me. No pressure, no hassle. But if you want to talk about how to make that move and where to go and all the things that are kind of like pressing on your mind when you look at moving to Florida, especially moving to the Tampa Bay area and the Central Florida area, I would love to talk to you. So hope you guys have a good one, and I hope to talk to you soon. Bye-bye.